Intel stock ticker INTC is one of the worst performing stocks in the S&P 500 this year. Over the past year, down around 46.5%, and year to date, down over 52%. And we had some breaking news. They just released their CEO. Now, if we come down here, you can see it says he decided to retire, but in reality, if we take a closer look, he was given the option to either retire or be removed. And what's really unfortunate for INTC is they've been struggling during a time when their market has been exploding. Again, INTC down around 46.5% over the past year, but look at these competitors. Taiwan Semiconductor up 100%, Nvidia obviously up over 200%, and Broadcom up around 80.2%. And this was once a stock a lot of people were attracted to because of the dividend. If we come over here and plug in INTC, all this data will automatically load in thanks to the help of the Ticker Data add-on. And like always, if you'd like to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. But here's what we can see. If we come down here, INTC had a history of increasing those dividend payments at a pretty decent rate. And then 2023 hit, and the company slashed their dividend by around 74 cents. And look what happened here. It looks like in 2020, the company generated about $20 billion in free cash flow. 2021, it fell to $9 billion. 2022, it went negative $9.6 billion, and then in 2023, negative $14 billion. So it's no wonder the company had to slash their dividend payment. And this was a pretty hot topic for a while in the dividend world, but here's what didn't get brought up. The company actually cut their stock buyback plan far before they cut their dividend. We can see right here in 2019, they bought back 13.6 billion in shares outstanding, 2020, 14.2, and then in 2021, it dropped all the way down to 2.4 billion. Now we can see during this time, they were paying out the same amount in dividends, so a lot of people felt okay about the dividend, but the share repurchase got reduced dramatically. Now in 2022, they were still able to increase the dividend, but that's because they started not buying back any shares. So because they didn't buy back any shares, again, it allowed them to easily pay out more in dividends, which was really just a short-term solution to a bigger problem. And then in 2023, we had the dividend cut, only paid out about 3.1 billion in dividends, a pretty massive reduction in the dividend payouts. And if we jump over to the stock screener, it's pretty easy again to see why this was the case. Look at the drop off in earnings. 2021 earnings per share 489 went all the way down to 195 in 2022, and 2023 around 40 cents. And the company actually released their latest quarter's earnings not too long ago, and it wasn't good. They not only missed by a large amount, but EPS normalized actual was negative, and so was it when you use GAAP, generally accounting principles. So they had negative earnings for Q3 in 2024. Now, if we look over here at the upcoming quarter's expectations, we can see most analysts are bumping up their earnings per share revisions, but we've already gotten guidance from this company on a generally accepted accounting principle basis. They're expecting negative earnings again. Now, non-GAAP, it's going to be slightly positive, about 12 cents per share. So yes, a little bit better than last quarter, but still pretty atrocious when you compare them to how other companies are doing in their sector. So the question we have to ask ourselves here is, what went wrong with INTC? All the other companies in their sector have seen massive growth, not only with share price appreciation, but when it comes to earnings and free cash flow. For example, look at Broadcom. If I plug in AVGO, look at the steady revenue per share growth. Look at the free cash flow per share growth. It's beautiful. But if we jump back over to INTC, free cash flow per share has been negative for 2 years in a row now. Now, what this really boils down to for INTC is going to be poor management and poor operational efficiency. For example, to start off, if we go over to our profitability and income statement sheet, look at how the gross profit ratio has deteriorated over the past few years. In 2021, it was as high as about 55.5%, and at the end of 2023, it was sitting at about 40.04%. And 2024 will likely be even worse. So not only is revenue declining, but we're seeing a lot of cost increases. But as I was researching INTC, I came across something pretty interesting. If we look at research and development expenses, we can see R&D is actually a pretty big expense for INTC. We can see in the most recent quarter, Q3 of 2024, R&D was around 4 billion. If we look at Q2, 4.2 billion, and Q1, around 4.4 billion. Now, why is this interesting? And this is something I was just pointing out on Twitter. Again, if we jump over to Twitter, we can see Nvidia spent around 3.4 billion in their most recent quarter on research and development. And this led to EBITDA of around 22.85 billion. Meanwhile, like we just saw with INTC, they spent around 4 billion in their most recent quarter on research and development, and this led to negative 5.2 billion in EBITDA. This is clearly due to operational inefficiency. And this isn't a problem that happens overnight. And this definitely isn't a problem that gets fixed overnight. And really, this is a clear example of why INTC lost confidence in their CEO and had to let them go. Not to mention, if we jump over to the company's balance sheet breakdown, we can see as of right now, their current ratio is sitting at about 1.3, which means they can meet their short-term obligations. But this has been deteriorating ever since 2021. It was sitting at 2.1, dropped to 1.57, dropped a little lower, and at the end of this most recent quarter was sitting at 1.31. Meanwhile, if we look at the interest coverage ratio, can the company pay back its interest payments with its EBITDA? And obviously right now the answer is no, because EBITDA is negative. So there's definitely some problems starting to pop up on the balance sheet as well. So what does this all mean for INTC, a company trading at about $24 per share, down around 46.5% over the past year? Is there any hope? Is there any short-term catalyst? Is the company trading at a good value? Well, the first thing that I think is interesting is we can see short interest for this company is about 2.73%. Now that is higher than most companies in the S&P 500, but not actually as high as you'd expect it to be for a company that some people claim to be going to zero. What this tells me is I do think some people think there is a potential turnaround play. So what are the potential catalysts? Well, first off, the US recently finalized a $7.86 billion CHIPS Act award for Intel to boost local manufacturing. Now, why is this a big deal? Well, if we scroll down, one of the things we can do is this is going to allow them to use funds to advance critical semiconductor manufacturing and advanced packaging projects at its sites in Arizona, New Mexico, Ohio, and Oregon. Along with that, they're going to be able to take advantage of some tax credits. Now, the reason this is a big deal is most of the world right now relies on Taiwan Semiconductor Manufacturing Company for their semiconductors. But unfortunately for TSMC, there is some serious geopolitical risk. And if you aren't aware of what's going on, to be very short, it boils down to China's interest in Taiwan. So in a weird way, INTC's advantage is due to one of the disadvantages for their competitors. And so when we talk about a turnaround play, if we jump back over to Seeking Alpha and look at earnings expectations from analysts over the next year, we can see by next year, analysts are expecting INTC to be positive when it comes to earnings once again. And in fact, by 2026, they're expecting them to recover to about $1.78. So if we jump back over to our stock screener, let's put that into comparison with where they have been previously. Now, obviously 2023, about 40 cents per share. We can see in 2022, about $1.95. So that puts them close to where they were in around 2022. But the years before that, we can see they're closer to about $5 in earnings per share. So it's clear there's no full recovery in play in the short term here. And with that being said, talking about this company from a valuation perspective is very, very difficult right now. Because again, we're talking about a turnaround play. It's really difficult to project what earnings, what free cash flow will be like moving forward over the next 5 to 10 years. For example, if we look at a reverse discounted cash flow analysis, assuming no free cash flow growth over the next decade, the company is worth negative $55 per share. Now, obviously, that's not what the market expects since they're currently trading close to around $24 per share. So let's just run a simple hypothetical to see what kind of recovery the company needs to get back to that current share price. For example, let's say maybe by 2026, the company gets back to about $9 billion in free cash flow just like they did in 2021. We'll take this number over here and paste it in. We'll say in 2025, the company generates $0 in free cash flow, and then after that, maybe we get 8% free cash flow growth. That puts us pretty close to around $24 per share. Now, obviously, this isn't the most sophisticated model. It's just an example of what would need to happen to get to $24 per share. And in reality, we have absolutely no idea what is going to go on with their free cash flow over the next few years. And that's what makes investing in turnaround plays so difficult. Historical data doesn't really help you, and it's really difficult to make projections. And so while there can be a lot of money to be made on turnaround plays, there's definitely a lot of money to be lost as well. As someone who wants to one day be able to live off dividends, that's my long-term goal. I want to make my investing process as easy and as predictable as possible. So when I look at a company and I have no idea what's going to be happening over the next few years, whether or not they'll be profitable, to me, that's an indicator that I need to stay away. Investing isn't just about being able to pick winners, it's about staying away from the big losers. And to add on to this, we don't have any idea yet who the new CEO is going to be. Unless Intel can find a CEO who can create a clear plan to profitability and future growth, again, I'm going to be staying away from this company. So like always, if you'd like to be able to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets, then you can head over to tickerdata.com at the link in the description. So go ahead and let me know what you think of INTC in the comments down below, and like always, please don't forget to like and subscribe to the channel.